Price deviation or slippage refers to the price difference between the expected price of a trade and the price at which the trade is executed. Slippage is a common error that occurs when during the volatility market and wide spreads, and then trades are filled at a price that is different from the requested price. Slippage refers to all situations in which a market participant receives a different trade execution price than intended. Slippage occurs in all market venues, including equities, bonds, currencies, and futures. Do not forget to subscribe. Please take a minute and look at a whiteboard for a moment. Let's learn some more stuff.
Slippage is when the price of a market, when opening or closing a trade, is different to what was expected. It is a natural occurrence, and it is very likely to happen at some point in time to your trades. Although it's often considered bad, slippage doesn't always have a negative effect on your trades. In the MT4 Instant Execution Account type order window, you can choose to set a maximum deviation pip range for your orders that is acceptable to you in the event that your order cannot be filled at the requested price. In other words, checking the maximum deviation box and setting it to 2 pips indicates that you are willing to accept a price that deviates 2 pips above or below the requested price. This will reduce the number of requoted orders, which is especially helpful at times of high market volatility. When the maximum deviation box is left unchecked, your order will only be executed if it is available at the exact price you requested. Otherwise, the order will be requoted. This applies only to instant execution. Example 1. Negative slippage while opening a trade. A trader intends to trade Google stock at a price of 100 and clicks to open the long position at this price. When the trade is executed, though, the price slips and the position is opened for Amazon at the 101, the new price it rose to. Example 2. Negative slippage while closing a trade. A trader is looking to sell Google stock at a price of 100 and clicks to close his open position. The price at the time of the execution when the trade is closed falls to 99, so in this case the trader has lost out by 1 point of value. Example 3. Positive slippage while opening a trade. A trader is looking to buy Google stock at a price of $250. As the position is opened, the executed price is $240, meaning the trader has opened a position at 10 points less than the intended for the same trade. Example 4. Positive slippage when closing a trade. A trader intends to trade Google stock, closing their position at a price of $250. The executed price that the position is closed at, though, is $275, meaning the trader has benefited from the slippage to a tune of 25 points. Example 5. No slippage when opening a trade. A trader intends to open a long position on Google stock and clicks to buy at a price of 200. The trade is executed at 200, meaning no value has been lost or gained from the expected price.
Hello traders, this is Igor from FX Secret YouTube channel, and I just need to say thank you to my colleagues for all these instructions before this moment. And right now we will talk a little bit more about slippage. So right now you see MetaTrader 4 window and the gold price you want to sell or buy, and we will ask ourselves right now, what is slippage? Slippage happens when a trade order is filled at a price that is different the requested price. And this is something normal thing. It's nothing some very bad thing like all people think. Slippage can be a common thing in forex trading, and it's very often understood. So slippage in forex tends to be seen as something negative. But however, normal market can be good thing for traders. When forex traders' orders are sent or filled by liquidity providers, some bank or anybody else, they're filled at the best available price, whatever the filled price is above or below the price requested. So everybody and brokers, everybody, they won't help us. So don't think about slippage as something bad, always bad in trading. I will just give you some example. For example, right now, we can submit an order. Right now, it's like you see 1904.53, for example, for gold right now price. And right now, we can sell at this price, and exactly the same number will be the sell position level for our order, and there's no slippage. But sometimes it can happen positive slippage. For example, right now I can try to buy gold. So the price is 90.05 right now. I can try to buy gold right now, and because some crazy volatility, price can drop 7 pips below my requested price in a second, and the order is then filled, and this is the better price than I wanted. You know, right now I can try to buy gold. Price is 1905.55 right now, as you see. I can try to buy this order right now, and maybe because of crazy volatility, I will buy at price 1904, for example, or 3, or something like that. It's a better price. So slippage can be positive. Of course, very, very often, slippage is negative because I can try to buy, price change above my requested price, and it's a bad slippage. I know. So sometimes I will lose money, sometimes I will get money. Slippage can be a problem, and a lot of professional proprietary companies, one of my companies that I work, we use guaranteed stop loss. It's a special thing. It's a little bit bigger price that we need to pay to a broker for that, but there is a guaranteed stop loss, and at a specific level, and it will be filled by the broker no matter what circumstances underlying in the market. So there will not be any loss because of slippage, and professional traders can do that. But slippage can be problem. For example, if you use a signal provider, for example, that can be problem because there is always some kind of delay. And can you imagine this thing? For example, you use some service, for example, zulutrade.com. They provide signals, for example. And there is a signal provider, some guy who trades for you. And that guy will create some kind of trade. And what will happen in that moment? Because of slippage, you will get maybe bad price, and there will be some kind of delay, and maybe 5, 6, 7, 8 pips you will lose because that waiting, because slippage, volatility in the market, and everything, and that can be the problem. But when you're an ordinary trader and you trade, for example, using MetaTrader 4 platform, slippage usually is not the problem. Sometimes you will have a positive slippage, sometimes you will have a negative slippage, and it should be no problem for you in trading. Okay, I have a couple good brokers that I use, like Hot Forex, like like FX Pro, AvaTrade, and a couple of them very often. I know there's a couple brokers that have a problem with slippage and the problem with a speed, but it's not a slippage problem. It's a more execution speed problem, and that delay and the problem execution speed, that can be problem for traders, and this is not the main topic for this video today. So we just talk about this. There is a couple questions that people ask when we talk about slippage, and which forex pairs have bigger slippage and which less, for example, something like that. In my experience, that forex pairs like euro dollar or US dollar, Japanese yen, and some volatility, and at the same time major forex pairs, usually they don't have problem with volatility, but there is a problem with other forex pair, exotics pair, for example, all pair that connected with British pound and Aussie Kiwi, like British pound Aussie, British pound Kiwi, something like that. You can see a slippage because huge volatility that we can see in that markets. British pound can be very volatile currency pair, and on the side, when you create that crossover currency pairs, it can be a problem. What I wanted to just say you one more thing when you talk about slippage is maximum deviation from quoted price. Right now on the screen you see option enable maximum deviation from quoted price. You can see that right now, and this is another problem. It's not related to slippage, but it's related to volatility market. So sometimes if you have a problem to enter into trade because you have a very important news, it's a beautiful news for you, for example, and you wanted to buy some currency pair, for example. You want to buy euro dollar, for example. You have an excellent result for euro, bad results for US dollar. You want to buy, but it's strong market volatility because you trade because of news, and news can be very, very big influence in volatility. And right at that moment, price drop, go up. It's a crazy volatility, up, down, and in that moment you can buy that trade if you enable maximum deviation. Just check this, enable maximum deviation for quoted price, and increase prime. You can put 30 pips, 20 pips, 10 pips. You can increase that deviation, and because 5, 6, 7, 8 pips in that moment is nothing for you, because you enter in this trade and you hope it will be 100 pips, 200 pips. It's a strong bullish trend for euro dollar, for example. And this is example that I wanted just to point to see how you can use in MetaTrader this enable maximum deviation for quoted price option to be better when we have volatility market. And this is it. I think that my friends and me in this moment, we talk everything about slippage. And if you have some questions, you can ask in comments, and I wish you great day. Bye bye.